Welcome. In this video, testing my highest profiting strategy on my strategy ranking spreadsheet, but this time using a 1 to 1.5 risk to reward ratio and using the naked eye for spotting the swing failure patterns instead of using the indicators for the swing failure patterns, because some people wanted to see it with the naked eye instead of the indicators due to the indicators' ability to repaint. So I believe either way is fine. You can do what you want to do your own back testing, of course. But in this video, we're going to see how it is with the naked eye, see how it stacks up against all those other tests that I did. I still believe it's going to do very well and that the indicators are just fine. But anyway, anyone can do what they would like to do. Let's take a look at some examples for this strategy so you can see exactly what I'm back testing. Then I'll get into the 100 back tests. So let's take a look. First signal here. We're looking for the trend direction. If price is over the 200 EMA, we only want a long. Price is under the 200 EMA, we only want a short. We're looking for divergence and a swing failure pattern on a pullback. And so here we have very clear divergence. We're looking for these pivots, higher low pivots, but at the same time, we get a lower low close on the price. Okay, so we can see that very clearly here. We get the higher low pivots to the upside. And on this candle, we get the lower low close, which also gives us that swing failure pattern off the lows over here. So no one can argue that's a swing failure pattern at the lows and a divergence present. We get the pivot to the upside here on this candle, which is our entry trigger. So we're using pivots confirmed on close. That is our entry trigger. With the swing failure pattern and trend direction in place. So here's the setup. That's the entry, 1 to 1.5 risk to reward ratio. Stop loss goes to the low of the swing failure, lowest point before our pivot to the upside on our indicator. So there's the setup. That's valid. Now our next setup over here, we have the divergence here. You can see get the higher low pivots on our stochastic K, right? And then at the same time, we're getting the lower low close right here. And see the swing failure off the lows here. Clear swing failure pattern. So we get our pivot up on this candle here. So that's our entry candle. Stop loss will go to the lowest point there, at the lowest point of the swing failure. And the 1 to 1.5 risk to reward ratio. So I don't think anyone can argue these are valid setups. We get swing failures, divergence, and we're in line with the trend over the 200 EMA. Okay. So we don't have any signals in here. We're going to go to the next one. Just one more long setup here. So this is the next long setup. No next valid long. While we did get some divergence in here, we actually did not get a swing failure pattern on pivot up. You can see we got a close down there below these lows. So if that had wicked up, potentially there could have been a swing failure, but we didn't get a swing failure here. Here's our next valid setup. So we get the higher low pivot up here on this candle, and it's a divergence, lower low close there, and the swing failure off the lows there. So very clear setup, can't argue that one. 1 to 1.5 risk to reward ratio there. And so that's the long examples. Let's go over to some short examples. I included a loss here so you guys can just see what it looks like when there's a loser. Here we have the short. We're under the 200 EMA, so we're only looking to short. We get our divergence. So here we're looking for the pivot down. Right here we get our first pivot down. And then we're looking for a lower high pivot that gives us the divergence and a swing failure. So here we pivot to the upside right here. It's hard to see, but we do pivot up. Look in the top left. You can see it goes 95.4 to 95.48. And then we pivot right back down on the next pivot down. So you can see our divergence right there. At that time, we also get the higher high on close, giving us our divergence, and pivot down with the swing failure off the highs there. So again, clear setup, valid setup there. There's our setup for the 1 to 1.5, and that one's all right. So here's another one. The next one, we get our divergence here, lower high pivot to the downside. And you can see it more clearly. If I zoom in here, you can see we went 97.21. And then for this pivot down, we went 96.49. So lower high pivot to the downside there, giving us our bearish divergence. And we have the higher high on close in between there with a swing failure off the highs. Okay. So we don't close over those highs. We get the swing failure off those highs, giving us our swing failure pattern. And then the pivot down confirms our setup for the entry trigger. Stop loss goes to the highest point, the swing failure up here. And we're going 1 to 1.5 for this test. So that's the setup. So let's move on to our next valid setup, which is down here. So this one's a loss. We had a swing failure up here. And at that time, you can see we have pivot down right here, giving us this high. So then we're looking for the swing failure at that point. We get a swing failure up there and a divergence with the pivot down right here. So that's our entry trigger. We go 1 to 1.5. It doesn't work out. That one's a loss. Okay, so all valid setups, spotting the swing failures with the naked eye. And so we'll see how this test performs. I'll fast forward through the 100 back test now, and we'll cover all the results and compare it to the others, see if it lines up where we would expect, or if going in with the naked eye is way worse than the indicators. So we'll find out. All right, the results are in, so let's take a look, then compare it to the other test that I did using the same strategy, but with those other tests using the swing failure pattern indicators instead of the naked eye. So we'll see how they stack up, if it's what we expect out of the results, or if it's massively different, way worse, like some people were saying might be the case. But we'll find out in just a sec. Let's first just go over the results. So this was tested on Bitcoin USDT, 15-minute time frame using a 1 to 1.5 risk to reward ratio. Took 199 days or 6.63 months for the 100 trades. And here are the results: 64 winners, 36 losses, giving it a 64% win rate. We had the most wins in a row at 10 and the most losses in a row at 6. So kind of what you would expect here based on the other tests. And then we got the gain on the account, risking 1% per trade and not compounding at 60%. So doing incredibly well still. Let's put it on the strategy ranking spreadsheet, see how it compares. So in the blue, I have the current test I just did in this video. And then in the green, I have the similar tests done, but using the indicator for the swing failure patterns in those tests. So 1-to-1 risk to reward ratio. Using the indicator, we got a 76% win rate on that test, 52% gain on the account, around 7 months or just shy of 7 months for those signals. So it lines right up. We had a higher win rate because it has a 1-to-1 risk to reward ratio instead of a 1 to 1.5. This time 64% win rate because we're using a 1 to 1.5, not a 1-to-1. Of course, the 1-to-1 has a higher win rate as expected. We have the 7 months here for the time to find those 100 trade signals, 6.63 months. So right around the same. I didn't do the exact on this one here, the 7 months. So it could have been 6 point something or 7 point something. But either way, it's very close there with the amount of time for the 100 signals. So it's right where you would expect it to land here. Now let's look at the 1 to 2. We had the lower win rate at 61% win rate. And we had right around the same time, just a little long, 7 months, 19 days. And that's exactly what you would expect. So as we get to that 1 to 2 risk to reward ratio, of course, the win rate will go down. Some of them will hit 1 to 1.5, but not 1 to 2. So that's exactly what you would expect from the win rate, to have a higher win rate if you have a 1 to 1.5 versus a 1 to 2 risk to reward ratio. So as you can see, a higher gain on the account figure here with the 1 to 2, but that's typically what we see, as I've spoken about with many other strategies. Typically that 1 to 2 risk to reward ratio just performs better, gets a higher gain on the account figure compared to the 1 to 1 or the 1 to 1.5 tests that I have done. So with the better risk to reward ratios, you typically see a better return on your investment. And then the variable risk to reward ratio, where we have the stop loss move to break even, some trade management, you can see we always get a better gain on the account out of that one. Again, same sort of deal with the time it took for the signals. I'm thinking it lines up perfectly with what you'd expect based on the other tests. So to say that using the naked eye versus those indicators would perform much worse compared to the indicators doesn't seem to be the case. It seems like it's pretty similar, and what I would have expected from the 1 to 1.5 risk to reward ratio falling in line with that win rate being exactly where you expect it to be. And the time it took for the 100 signals right around where you'd expect it to be, seems to be pretty similar, not a huge difference, using the indicators versus using the naked eye. The biggest difference was it took me way longer to do the back test because I had to go in and look for each swing failure instead of just having the indicator to tell me which swing failure to look for a divergence at. But anyway, that is the result here. I wouldn't say that using those indicators, I know the complaint for the previous test was that the Lux Algo indicator can repaint, but it doesn't seem to have made a big difference, and the result seems to be like the results are still great with the naked eye. And so if you don't like the indicators, just use the naked eye for your swing failure detection, or if you don't like swing failures at all, just use divergence or something else. Do your own testing, of course, figure out how you're going to look at it. Might be a little bit different than how I look at it. So do your own tests, see what you come up with. For me, divergence combined with swing failures and trend, great combination. Going to stand by that still. Indicator, no indicator, I think that it's, both are fine. So seems like both will likely make money. Obviously, we don't know. This is a small sample of testing, but do your own testing, figure it out, find out what you like. And that's it for this video. Hopefully it was informative, and have a great day, everyone.